Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing HIMX's stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. HIMX is a fabless semiconductor company. Fabless means the company outsources manufacturing of its silicon wafers and chips. Fab is short for fabrication, which is just another word for manufacturing. HIMX is a market leader in display driver internet circuits and timing controllers, used in TVs, laptops, monitors, mobile phones, tablets, digital cameras, car navigation, virtual reality devices, and much more. It has a 40% market share in driver integrated circuits for auto displays. The company has over 200 customers across Taiwan, China, Japan, Korea, US, and Europe. It has over 3,000 patents granted and 500 pending approval. The company is headquartered in Tainan City, Taiwan, and was founded in 2001. The ticker trades on the Nasdaq, Deutsche Börse, and London Stock Exchange. Let's get started with the model. This is a small cap company, 1.6 billion market cap. They're trading at $9 a share, and they have 174 million shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. They did have a negative in 2019, but it's going up quite a bit each year. It's at $390 million in the trailing 12 months. Net income is the profit or loss on the income statement. It's revenue minus expenses. That's also negative in 2019, almost $500 million in the trailing 12 months. Revenue is the sales for the company, and that goes up a lot from $700 million to $900 million to $1.5 billion to $1.65 billion. This is the company's income statement. The top line is the revenue, the sales. Below that is the cost of revenue. These are all the expenses directly related to generating the revenue. Revenue minus cost of revenue gives you your gross profit, and that's up from $138 million to $818 million. Below that is their operating expenses. These are all the expenses not directly related to generating the revenue. Gross profit minus operating expenses gives you your operating income. That was negative in 2019, over $600 million in the trailing 12 months. They received $1 million of interest on their investments and paid $1.1 million of interest on their debt. Then you have other income and expenses. These are all the gains or losses not part of the company's core operations. They had a gain of $2.4 million in the trailing 12 months. Your pre-tax income, your taxes, and the bottom line of the income statement is your net income, which was negative in 2019, only $45 million in 2020, so a 10x from 2020 to the trailing 12 months. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company generates from its operational business. They generated $400 million in the trailing 12 months, which is up a ton from 2019 of only $8 million. Then you have CapEx, investments in property, plant, and equipment. Since they outsource manufacturing, they don't spend much in CapEx, only $10 million in the trailing 12 months. Operating cash flow minus CapEx gives you your free cash flow. And they have a lot of free cash flow now, so they pay a dividend. But it looks like they're putting most of that money back into their business to grow it, because they added debt in the trailing 12 months. They issued $654 million, paid down $618 million. But as we saw in the income statement, they bring in as much interest on their investments as they pay in their debt. So they can easily afford the interest on their debt because they have so much operational cash flow. Let's look at the capital structure. $1 billion of equity, $200 million of debt. They're 83% equity, 17% debt. And they could pay off all the debt with the cash on their balance sheet and still have $245 million of cash left over. The WACC on Finbox ranges from 9% to 11%. I gave them the highest WACC of 11%, and that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's $2.5 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $2.4 billion. We divide that by 174 million shares. And we get a calculated stock price of $14. They're trading at $9, so they're trading at a 34% discount. It's a buy according to the model. Their revenue target for 2024 is $1.3 billion. For 2023, it's $1.4 billion, and for 2022, it's $1.5 billion. And I continued this trend into 2025 and I got 1.2 billion. That's how I got their future revenue estimates. They convert on average 17% of their revenue into free cash flow, so I multiplied their future revenue estimates by 17%. That's how I got their future free cash flows. The website Simply Wall Street values the company at $23. They're saying it's 61.2% undervalued. 3 analysts priced this stock and the average price target is $12.67. The low target is $11 and the high target is $15. This is where the stock has been trading the past 5 years. In 2018, it was about $13 a share. And before the COVID crash, in the middle to end of 2019, it looks like it fell to about $1.50. That would have been really impressive if you had the foresight to pick it up at that low point. And then in the beginning of 2021, it shot up like a rocket ship to about $17.50 at its peak. It's been cut in half since then, but it's still up a ton compared to the end of 2019. But it is down from the beginning of 2018. So this stock is pretty volatile. It moves all over the place. In the past 5 years, this stock is up 10%. Nvidia, which is one of the biggest semiconductor companies, is up 322%. The largest semiconductor company, Taiwan Semiconductors, is up 129%. The semiconductor ETF SOX is also up about 129%. These are the top 10 largest holdings in the ETF SOX. Broadcom is about 9% of the portfolio, then Advanced Micro Devices, Nvidia, Intel, Qualcomm, Analog Devices, KLA, Texas Instruments, Microchip, and NXP. They pay an annual dividend, and they cut their dividend in 2019 and 2020. They brought it back in 2021. It's a yield of 3%, which is only 12% of their free cash flow, so they can definitely afford to pay a bigger dividend. You can see their yield is all over the place. It looks like it was about 5% in 2011. And I'm not sure how accurate this is, but the forecast is for their yield to be 11.5% by 2024. And the forecast is about 15% in 2023. I'm not sure why they think the yield will be so high. It looks like their next dividend is in July 12th. So if you want this dividend, you have to own the stock on June 28th or before. If you buy the stock on June 29th or after, you will not get the July 12th dividend. They have a beta of 2, so the stock is volatile. It moves 2 times the market. It's gone down 36% in the past 52 weeks, while the S&P is down 11%. The 52-week low is 7, the high is 17, and the ticker is on a downtrend, trading below its 50-day and 200-day moving average. 3 million shares are traded each day on this stock. Of the 174 million shares outstanding, 125 million are on float. 22% are held by institutions, and it has a high short percentage. Over 12% of the shares are shorted. If you put $10,000 into this company 10 years ago, you'd be really happy. Over $60,000 today. That's a 522% return, a 20% annual return. 48% of the company is held by the general public, 28% by insiders, and 24% by institutions. Their employee count is pretty steady over the years. They're currently at 2,100 workers. These are their biggest shareholders. The founder at 22%. His valuation is $336 million. Then another individual at 6%. It looks like a management company at 4.4%, Lazard at 2.3%, Alliance Bernstein, and a bunch of other companies. Let's look at their financial ratios. Holy cow, a PE of 3.2. That's stock price over earnings per share. So much better than a market median and market average. Price to sales of 0.9. That means their revenue is higher than their market cap. Price to book of 1.6 and a price to free cash flow of 4.0. So if you're a big fan of price multiples, the stock seems really undervalued. They have a really high return on invested capital of 65%. They can easily cover their interest payments. ROE of 49% and a high current ratio and quick ratio. They generated $390 million of free cash flow in the trailing 12 months. They have over $700 million of working capital. Working capital is current assets minus current liabilities. And they paid out $47 million of dividend payments, so they have over $1 billion of funding. So it does seem like the company has enough money to get through the next 12 months pretty easily. The best way to look at ratios to compare them to companies in the same industry. There are 67 companies in the same industry as HIMX, and if HIMX has a number in red, they're worse than the average. If they have a number in blue, they're better than the average. They don't spend much in CapEx since they outsource their manufacturing. They outsource to companies like Taiwan Semiconductor. They have a good debt to equity ratio, only 0.2. That means for every dollar of equity, they have 20 cents of debt. They pay a high dividend relative to the average. They generate less free cash flow than the average company, but they are a lot smaller than the average. Their market cap is $1.6 billion. The average is $32 billion. They rank 39th in market cap of the 67 companies. Their price multiples are amazing. Look how much better their price to free cash flow and price to earnings are compared to the average. But if they were headquartered in the US, their market cap would be a lot higher, even with the same exact numbers. They generate $1.7 billion of revenue, the average is $6.6 billion. But their 5-year annual revenue growth rate is 16%, which is double average. They have a really high ROA and ROE. So to summarize, I have them trading at a 34% discount, and I think this company is a hidden gem within the semiconductor industry. Not many people talk about HIMX, but they've been doing really well the past few years, as a lot of semiconductors have been, because the demand is so high. But we're in such a bear market, there is a lot of uncertainty. But I think this is okay for a long-term hold. I think they have a good future, and I think they're an acquisition target, especially for a bigger company like Nvidia or Intel. I rank their free cash flow 6 out of 10, their revenue 7 out of 10, and their ratio is 10 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.